Hello everybody, I'm Dumisha Greater, investment analyst at Net Group Investments. While it's been almost 3 months into the new year, and yes, there are some things that we can smile about. Firstly, we've had South Africa who has lowered their more stricter COVID-19 restrictions, and we also welcomed our first supply of the COVID vaccinations. So yes, we are certainly in unprecedented times, and it really has been interesting to see how, key institutions around the world, such as central banks and governments, have responded to the impact of the COVID-19 pandemic. But yesterday, we had all eyes and the spotlight firmly on our national government, and as they tried to communicate to us, what they were going to do in terms of the needs of the present and those of the future. I guess the question then becomes, did National Treasury accurately assess the situation when it comes to how they're going to get this balancing act correct? Well, I think the answer, if you looked at the stock market yesterday or the fixed income market, you would have said yes, possibly South Africa can weather the storm. We saw the rand strengthen, we saw bond yields moving lower. The situation at the moment is a little bit different from what we saw then. But to have somebody now who's going to help us unpack this, who has looked at the 200-page document that is the budget review and has years of experience, is our chief economist, or the group chief economist at Nedbank, Nicky Weimar, who joins us now to give us more insights on this. Nicky, thank you so much for your time, and we're very, very keen to have you talk to us about this today. I know that we have got a lot of ground that we do need to cover, so perhaps take it away with the presentation before we start delving deeper into our discussion.
Thank you very much. Absolutely. So let's get the show on the road. My aim today really is to give you a sort of a bird's eye view of the budget. I'm going to highlight those little key areas because I understand the organizers really want to get through as many questions as possible. So I'll keep my talking to a bare minimum. So before we delve into the 2021 budget, let's just remind ourselves where we come from, right? Because that's actually the bit that matters. We come from a situation where South Africa's fiscal position has deteriorated systematically and persistently really since the 90s. And the graph you're seeing here really illustrates that. It shows you the hippo's jaws, as our finance minister puts it so visibly and vividly. And you can see how they've really just opened very, very wide, and revenue and expenditure have diverged from each other. But this pattern has been made a lot worse by COVID, but it didn't start with COVID. It started long before that. We've had been running budget deficits of over 3% of GDP for quite some time. Expenditure have consistently outpaced revenue, and actual budget estimates over the last couple of years, and revenue have disappointed at such a point that by the end of 2019, government made it clear that tax buoyancy was actually less than 1%. In other words, for 1% growth in GDP, you collected less than that in terms of taxes. So the reality is we've been on an unsustainable fiscal path for quite some time, and we didn't get there overnight. And what I'm trying to show you here in these little spiral graphs on the side is just how these things come about. If we look at revenue, we've had corruption, state capture, we've had very poor policy decisions that did unnecessary damage to the economy. You combine those two, and they've been particularly destructive as far as state-owned enterprises are concerned. Why do state-owned enterprises matter? Because we've decided that they will provide the bulk of economic infrastructure in South Africa. So as a result of this, we just have to think about a Medupi and Kusile, hardly the most efficient power stations ever built. We spent, well, more than double what we budgeted for on both of those power stations, and only to discover that they are structurally flawed, and the new management of Eskom is now trying their very best to get as much operational capacity out of them as possible. But the truth is we've been living with this constraint for quite some time. It's been devastating. We've had electricity outages since 2008. That was the first time we encouraged or experienced the crisis. You combine that with other infrastructure, which is inadequate, insufficient, and unreliable, and very expensive. Road, rail, port infrastructure. We have among the highest port tariffs in the world, even in Africa, which doesn't really make sense because we've got better absolute levels of infrastructure. So all of this is just slowly and systematically raise the cost of production, undermine companies' competitiveness, and of course, destroy confidence. And in the process, we've seen economic growth fade. Now, if growth fades, companies make less profits, government gets less taxes. If companies are not making profits, they can't expand their operations. If they don't expand their operations, they simply don't employ people, and consequently, government gets less taxes. If people have less income, they spend less, so government gets less taxes. So that's been the pressure revenue's been under. But of course, these things are related. So the strain on the one side of the equation spills over to the other side of the equation. And so if you've got higher unemployment, you've got a higher social burden, you've got higher crime levels, then corruption, poor decisions, bad management, no accountability has really led to a situation where almost all our SOEs are financially broken. They really rely on state help to service the interest on their debt, and some of them even to pay the salaries of the employees. So that adds to your expenditure bill. Then, of course, during the Zuma years, again coming back to bad policy decisions, it was a deliberate decision made to grow the size of the civil service. A lot of that, of course, had to do with the patronage system. And so the state became the de facto employer of last resort. And so your public sector wage bill exploded, right? And that meant that the hippo's jaws just kept widening and widening and widening. You had to borrow more money, so now debt service cost is rising, plus all the inefficiency, and suddenly you have persistently high levels of expenditure. You may budget for slower growth in expenditure, but it always overshoots. And of course, COVID made all of that worse. So that is where we were. And on October last year with the mini budget, we were presented with this incredibly grim and gloomy story. So now the question is, fast forwarding to yesterday, what was the news? Did anything improve? Will South Africa emerge from this fairly gloomy state? Will we literally weather the fiscal storm? So that's the question we're going to try and answer and take you through government's plan, and specifically National Treasury's plan, to get us through what is undoubtedly a very tight fiscal spot. Right, so let's look at this year's budget. So let's start by seeing, was last year as bad as they thought it would be in October? So National Treasury thought we would run a budget deficit of 15.7% of GDP, which is absolutely frightening last year, but we didn't. Luckily, we didn't. It's still ugly. Listen, it's still bad, but not quite as bad as we thought. It's going to be a deficit of 14.7%. Now, what made the difference? It wasn't expenditure, because expenditure was fractionally higher than they thought it would be in October last year. The big difference came in revenue. Instead of shrinking by 15.9%, revenue only contracted by 11%. What made the difference there is the moment they got rid of level 5 lockdown, and they started easing those lockdown restrictions, the economy actually bounced back a lot quicker than they thought, and as a result, revenue collection rebounded. And I also sense that things are starting to fall in place at SARS. SARS is under better management, so the efficiency of tax collections have also improved. So that's all good news. It's still an enormous budget deficit in the double digits, completely unsustainable, but at least it's not as bad as we thought. So now we're going to move forward. We're going to look at the next 3 fiscal years. The one we're going to enter right now, which is 2021-22. Then we're going to look at 22-23 and ultimately up to the final year they budget for, which is 23-24. And we're going to look at the revenue, the expenditure, and the deficit picture from that side. So what's the best bit about yesterday's budget? Well, they got a little bit more ambitious in trying to reduce the budget deficit. You will recall, if you look at this red line here, this was the budget trajectory they set out in October last year. It was horrendous, and the anticipation then was to very slowly try to close the hippo jaws, and very slowly try to scale back the budget deficit to around 7.3% by the time we get to 23-24. They've gotten a little bit more ambitious. They think they can do a little bit better than that. And the aim is now to bring down the budget deficit a little bit faster and to get us to 6.3% by the time we get to 23-24. Listen, it's still a gigantic budget deficit. And we are still not within reach of that 3% of GDP, which is a sustainable level. So we're still very much running a fiscal policy that is hugely unsustainable, but at least the ambition is there to reduce it a little bit quicker. So that's a bit of good news. How are they going to do this? That's the next question. Well, here I show you the hippo's jaws again. The thin lines were the estimates they had for expenditure and for revenue, the little dotted lines, the thin ones, in October last year. The thicker lines, that is the estimates or revised budget they came out with yesterday. And you can see they are really counting on revenue bouncing back stronger than they expected. So they're expecting revenue to do the heavy lifting, and for that to look a lot better than they thought it would in October. On the expenditure side, they've got a cut built in for this year, but then over the 2 outer years of their forecast period, they've actually got higher expenditure numbers, but it still shows restraint, and we'll delve into that a little bit later on. So why are they a little bit more optimistic about revenue? I think there are 2 reasons. The economy has proved more resilient than they thought it would. That's the first thing. The second one, obviously, being that it looks, like I said, as if conditions are starting to turn around at the receiver of revenue, and that is good news for South Africa as a whole. So if you are going to come up with, if you're going to rely on revenue, you have to have realistic GDP forecasts, right? So they can't be totally unrealistic. And so the first question we have to ask is, are their GDP forecasts for the next 3 years realistic? And we would say yes. The first little chart here, I show you their estimates that they came out for GDP growth in October last year, and then I show you the ones they came out with yesterday. And you can see last year is going to be a little bit better than they thought. They're coming more in line with the market estimates there. And then this year they're expecting 3.3%. They didn't change it. And then slightly firmer 2022 and 2023, but really marginal stuff. Is this realistic? Well, you can compare it with our forecast, and you can compare it with the Reserve Bank's forecast. I'm not saying our forecast is everything, but we are pretty good at forecasting GDP, I can tell you that. And as you can see, they're not wildly out of line at all. In fact, the Reserve Bank is more optimistic about our growth prospects than either us or National Treasury. So I would say yes, it is very realistic. They are also, although they're not banking on it, they are also hoping that the Reconstruction and Recovery Plan that was announced last year would make a difference to the growth outlook, and that it would give them a little bit of a lift, a little bit of a dividend. And of course, the 3 or 4 pillars, rather, of the Reconstruction and Recovery Plan is all sensible stuff. There's nothing wrong with the plan itself. I know it's been slated all over the place, but it contains the basic elements that South Africa need to change in order to move forward as an economy and in order to unlock greater efficiencies and also stronger economic growth. So the plan itself is not absurd. It's not far or outlandish or ridiculous. The problem, of course, is all of the proposals put forward in the plan simply never gets implemented. That's where South Africa falls apart. It's not in designing plans, but in actually just changing the legislation. We say we're going to change. We say we're going to change it, and yet we never change it. So it's got 4 pillars: defeating COVID. It's been slow going, but at least we've got the vaccines going. At this point, according to the Department of Health, we will be reaching, if we stick according to the vaccination plan or inoculation drive, we will reach herd immunity by early 2023. Now, given that this is South Africa, we probably have to consider that we probably won't stick to the inoculation plan. It will probably go slower than we anticipated, and maybe somewhere during the course of 2023 we reach herd immunity. Okay, then the other element is really accelerating growth for infrastructure development. As you know from the State of the Nation address, the president said we're going to start a massive infrastructure program. So they're hoping that will give them a bit of lift. Then there's economic reforms and so-called structural reforms. These are difficult things to effect, but they are absolutely essential. And that's what the rating agencies are looking for. And then finally, of course, there is fighting corruption, which is very important. And I think there the public is getting very impatient. We want to see a few people in orange uniforms. And then, of course, we also want to see government strengthen the state. And that would also make a big difference to their capacity to deliver. So all of these things make sense. It's just been moving very slowly. But like I say, in the budget, they actually don't bank on this. It's not included in their estimates. They say that it will only produce results over the medium term, and I think they are right. It's not going to make a big difference to the South African story in the very short term. So now let's delve into each of these categories. Let's firstly look at revenue. So you can see on the revenue side, they are looking for growth of 11.6% in revenue this year, and then 7.6 and 5% in the final year of the medium-term framework. So is this achievable? Yes, I think it's highly achievable. Bear in mind, just look at this year, for example, 21-22. Last year, revenue contracted by 11%. You've got more levels of economic activity. You have companies starting to pay taxes. All the deferrals will also now come in. So the back taxes will also come in. So there's a big base effect there, which is definitely more than 3%. On its own, it's probably close to a 5 or 6% increase just on its own, the base effect. Then on top of that, you're expecting 3% growth in real terms. You've got inflation of about 4%. You are definitely going to overshoot that 11.6%. And the outer years also very conservative. I think they will definitely do better than that. So revenue, very realistic, very conservative, and they're more than likely going to overshoot on this front. And it is because of that, I think, that they were capable of going, listen, everybody, a horrendous year in 2020. This is the worst time in the world that you could even be considering tax increases. And I know that as South Africans, we all braced for it. But the good news of this budget, other than the faster pace of deficit reduction, is that they refrained from that. And it's really a tax-neutral budget. They give you some relief in that they make compensation for more than the effects of inflation to the various tax income brackets. So that makes a difference. It gives everybody a little bit, and I mean a little bit of money back in their pockets. But then they also take from you in the form of higher indirect taxes, which are your usual excise duties on alcohol and tobacco. That's where they'll get the bulk of their money. So that's revenue. There's nothing exciting there, but there's also nothing outright damaging there. So if we now look at expenditure, now here is where it becomes tricky for South Africa and for government and for National Treasury, because you can see that they have planned for, they're illustrating expenditure restraint. They are signaling their intent. They want to rein in expenditure. There's no denying that. So they want to cut expenditure in nominal terms this year by 1.6%, right? Now, let me tell you, that's in nominal terms. So in real terms, that's a real cut of over 5%. This is something government has never achieved. Even during the manual years, you had real cuts in expenditure, but they were fractional. And really, the whole idea was just to keep expenditure within the rate of inflation in nominal terms, and that way you keep expenditure constant in real terms. So to achieve such big cuts, and especially a nominal cut this year, that will be quite an ask. And then to maintain it to less than the rate of inflation, which is a real cut in spending over the last 2 years of your medium-term framework, that is also going to be an ask. So let's evaluate their prospects of actually succeeding at this. Okay, but before we do that, we do need to understand, literally, what are the biggest spending categories? Where should they focus their attention? So there you go. The biggest one is compensation of employees. Look at that red bar. It is 32% of government expenditure. Then the budget debt service cost, which is a function of the budget deficit, has grown very rapidly. It's now 13.4% of expenditure. And the rest really isn't that surprising, given that South Africa's high unemployment, huge legacies of discriminatory practices where big parts of the population was left behind in terms of education, infrastructure. We have large levels of inequality. You would expect education to take up a big portion, social protection, healthcare, economic affairs, and also high crime levels, public order and safety. So that's not too surprising. So where should they really be focusing their attention? Well, they should focus it on that red bar. And that's the good news. That's exactly where they're focusing it. So we're going to look at that a little bit more detail. But first, I just want to illustrate really the legacy of running budget deficits of over 3% of GDP for over a decade and what that does to debt service costs. So let's just quickly, vividly illustrate this to you. What happens here? Well, we've been running these enormous budget deficits for an extended period of time. It accumulates over time. You have to borrow more. Your debt starts to surge at an unsustainable level. You have sovereign risk rating downgrades. That's another reason why it was absolutely essential we keep our investment grade status. And your interest costs go up because you've got a higher risk premium. And what does this mean? Debt service costs become bigger and bigger. It grows faster and faster. And that's exactly what we're looking at. It will be the fastest growing expenditure item in the budget over the next 3 years. And what it will do is, as a share of total expenditure, it will go all the way up to 16% from 13.4%. It will gobble up 21% of our tax revenue by the time we get to 2023-24. So unsustainable, totally. In terms of how do we compare in terms of what our debt service cost will eat up of tax revenue over the next 3 years with other emerging markets, sadly, we're not looking good. The only one, the worst of the lot is Sri Lanka. So thank goodness we're not Sri Lanka. India, of course, is mainly as a result of them having had a really terrible experience with COVID-19. They've had repeated lockdowns, and as a result of that, we've seen a situation where they now have had to borrow a lot more, but they grow a lot faster than us. So we're in bad company here, and in the emerging market universe, we've got one of the highest debt service burdens out there. The focus, though, of this budget literally has to be on cutting public sector wage bill. The success of actually meeting those expenditure targets depend on us really being able to restrict growth in public sector wages to what National Treasury has penciled in for the next 3 years. So last year they had a wage freeze, so wages only grew by 2.1% in nominal terms. In real terms, it was a cut. They're hoping to maintain it this year to the same level and then bring it down to even weaker levels. In real terms, these are big cuts in spending. Okay, so the bottom line is this will be a fight. The worst bit about it is we don't know if they're going to succeed. Remember, there's the Constitutional Court hearing that's coming up, and that's about last year's wage fees. So they may have to pay back wages, and that will be an enormous increase in the bill that they'll have to fit. And then they miss the revenue targets. Done. And then the wage negotiations for the next 3 years only starts now. Now, is government being unreasonable towards civil servants? Are they being just too demanding and too cruel? The answer is no. Just look at the type of increases they have achieved over the last couple of years. It is well above the rate of inflation. In the private sector, I can tell you the average increase has been between 4 and 5%. So everybody has taken a cut except civil servants. All right, so everyone's made a sacrifice except civil servants. And really, given the size of our economy, given our tax base, the public service is enormous. A lot of it has to do with the deliberate strategy followed during the Zuma years to grow the civil service and to grow the patronage system. How big is it? It's enormous. How much is civil service compensation of employee as a percentage of our GDP? It's among the highest in the world. Among the highest in the world. We're second to Norway and Denmark, which are ridiculously wealthy countries. So it just does not make sense. So yes, it's the right place to go, but unfortunately, we do not know if they will be successful. So they want to contain. The success of this thing hinges on keeping the public sector wage bill to 1.2% growth over the next 3 years. Everything else they're cutting, all right? Absolutely everything else. Debt service cost, well, that's going to be the fastest growing item in the budget going forward. All right, so quick point here on just Social Security. I know we always carry on, oh, there's 18.5 million people receiving some kind of government payout. That's true, but bear in mind, it only makes up about 3.4% of GDP. I take you back to compensation of employees, 14.8% of GDP versus 3.4% of GDP. Big, big difference, right? And this prevents absolute suffering. So I don't think that this is our biggest problem. Right, so our biggest problem and the biggest challenge will be success with compensation of employees. The last element is this whole thing that the government's talking about, that they are embarking on this massive infrastructure drive. Just to put that in perspective, that is not happening. So there is their actual budgeted estimates for capital expenditure. It's going to go from 187 to 275 billion. When you look at those numbers like that in nominal terms, you say, well, that's impressive. But it really isn't. All it is that infrastructure spending remains at 4.7% of GDP, which is desperately low for a country with an infrastructure constraint, and desperately low for a country with essentially is an emerging and developing economy, where you'd expect this to be higher. It is essential that we put emphasis on infrastructure. Look, the collapse in SOE investment, which is basically our infrastructure, is the biggest drag on this economy, especially energy shortages. So if we want to do anything, let's be honest, it's not going to happen until we solve the energy crisis. It's just not going to happen. And just to quickly point out to you, despite the fact that we've built 2 new power stations over the last decade, Eskom today, which is that red line, produces less electricity than they did in 2004. You can't make this stuff up. It's absolutely remarkable. All right, so infrastructure drive, it's just not going to happen. It is reliant on us solving the energy problem. So now let's look at the deficits. Last bit of our presentation, and we have got very little time left. So if we have a look at it, will they be able to make this budget deficit? I think the risk to the expenditure estimates is just very high, and there's no guarantee of success. And there's a very strong possibility that they're going to overshoot on the expenditure side. But equally, they're going to overshoot on the revenue side, because they appear to have been deliberately quite conservative in their estimates. So maybe they'll come close to these budget deficits. It is absolutely essential that they do try and meet it, because look how high our budget deficit over the next 3 years is compared to our emerging market peers. Again, we're in the top quartile, and this is not for a good reason in the top quartile. So we have among the highest budget deficits out there in the emerging market universe. And what that really means is that your debt continues to escalate and continues to escalate, and your funding burden continues to rise. But if they can stick to the deficit targets they set out yesterday, they can contain the debt trajectory to a peak of 89% of GDP, which I think you'd agree with me is a lot better than what they saw in October of 95%. How will they fund it? They're going to fund virtually all of it through the domestic bond market. Will that be possible? Well, what happened last year? Debt issuance increased or tripled, fourfold. I think it's fourfold at the end of the day. And yes, it was financed. Who financed it? Yes, foreigners reduced their holdings of South African government debt quite substantially. Who took it up? Monetary institutions, which are banks, and other monetary institutions. So rating agencies have always said South Africa has deep and liquid markets, capital markets. This is true. We funded an enormous budget deficit last year, and we did it predominantly through local funding. But there are consequences to this. Government will be able to fund these deficits, but they will be crowding out the corporate sector. That's the problem, which is another reason why fixed investment activity is not going to grow rapidly in the years ahead. So bottom line is, things might get a little bit better for us on the funding side. You see very low interest rates in your advanced countries. You see that they're continuing to pump liquidity into the system. You also see the end of the coronavirus in sight. Vaccinations being rolled out very aggressively in most of your advanced countries. Risk appetite is returning. South Africa will not be the main beneficiary of it this time around. It's going to go to China, to your Asian emerging markets. But at least it's brought some stability. You're seeing some renewed interest in our bond market. Might make it easier for government to fund that deficit. And we've even seen foreigners have stopped selling our shares. So that's also good news. So things might get a little bit easier. So if I had to sum it up really quickly, what does this all look like? What does it mean? How do we look at this budget? Will we weather the storm? Yes, we will weather the storm. Will government be able to fund these deficits? Yes. Will they need to go back to the IMF? No, not if they stick to the targets they've set out here. Are those targets vulnerable? Yes, they are very vulnerable. Why? Because it all depends on success in containing the growth in the public sector wage bill. And we just don't know what that outcome will be. And then I think a key push for them is that if they don't have success with the unions, they've got to reform state-owned enterprises. They've got to reduce the reliance of state-owned enterprises on the fiscus. That will free up billions, which they can use to reduce the deficit. And yes, we have a daunting tale ahead of us. We will weather the storm. We will fund it, but it is going to come at the expense of weak fixed investment activity and probably 3 years of really moderate economic growth, limited job creation, and very little fixed investment activity. So that's my tale. I'm sticking to it for now, so I'll take whatever questions you might have.
Thank you so much for that, Nicky. It's always great getting your insights. I'd like to just maybe start off by talking about the growth outlook. So we've looked at the Nedbank growth outlook for 2021, and it looks as though it's in the region of about 3.5%. The South African Reserve Bank looks at about 3.6%, with National Treasury saying 3.3% for the 2021 year. So what's interesting in the budget review is that the National Treasury had two scenarios apart from the base case that you've discussed. 3.6, which is blue skies if everything goes well. But there's also another case which I think has been less spoken about, and that is if things don't go very well, then 1.6% is basically what we'll be looking at for the 2021 year. You've mentioned a host of things, and of course we've got a big task ahead of us. But for you, what would you say are maybe the top three things that we need to be looking out for, that if we start to tick these off, then that 1.6% growth rate for this year is very much going to be a reality for us?
You mean the 1.6%, are you saying what could go wrong to get us as low as 1.6%? Is that what you're asking?
That's correct.
Okay. So what could go wrong is, that Eskom implodes. That's usually something that would happen. In the case of South Africa, Eskom's already indicated that the risk of load shedding is elevated until September. From September onwards, things do get better. We get window 4's renewable energy coming on stream that will provide them with some relief. And they are also making progress with their so-called deep maintenance. Sounds very suspicious, but their deep maintenance program. But Eskom, I think, is under different leadership. I have to tell you, we've been getting better reports from there. It looks like it's being fixed. It was just such an enormous mess that it will take years to get it right. And at the same time, so, if the implosion in electricity, if load shedding is of an even greater intensity than we are currently worked into our numbers, and trust me, the Reserve Bank's got load shedding in their numbers, we've got load shedding in our numbers. If it's worse than we anticipated, then that could take us to 1.6%. If the global economy disappoints, if some horrendous variant of COVID-19 appears on the ground that no vaccine can deal with, which I think is highly unlikely, because I think they are starting to understand this, and they're making a lot of progress in the medical profession with developing a generic vaccine that will deal with other variants as well. So that's highly unlikely, but that could throw us off course. And then, of course, I think you have to bear in mind that if South Africa is particularly slow at literally rolling out our vaccine, which will mean that travel restrictions will remain in place. Other countries will probably continue to place restrictions on us, on our entry and our movement. Tourists won't be returning, and so some industries will start to look very, very vulnerable, and you could see very, very significant and very long-lasting damage in things like hospitality, air travel, and so forth. And then you also have the possibility and the ripple effect that results in an even bigger bill to the fiscus from SOEs, particularly in SAA, if you're determined to keep it alive. So these are the things that I believe can go wrong that could get us to that 1.6%. However, 1.6% is extreme. Okay, it really is from a base of minus 7.6. What is the most important thing we should not have again? Level 5 lockdown. That's when all the damage was done to this economy. And if we can avoid level 5 lockdown, we will have growth of more than 1.6% this year.
Well, thanks, Nicky. Perhaps maybe let's just go on to our next point. You mentioned in terms of the revenue side, nothing exciting there. Fortunately for South Africans, we were able to get some reprieve, but that financing of the budget deficit, and I want to maybe refer to one of the slides that you put up, which was quite interesting. It needed to be financed, and South Africa was able to do that through our bond market. We've spoken about some of the things that can go wrong and how foreigners now hold not as much or lesser proportion of our local bonds. Should we continue to see a deterioration in our credit quality, and we've seen how banks have now stepped in, if things went wrong, and again, I come in a risk of sounding a bit like a pessimist here, but would a systemic risk to the banking sector, to the financial sector, be something that we need to be concerned about, given the fact that we do need to fund this budget deficit, from the local bond market?
Okay, so let me put it this way. Banks are not excited about the prospect of, having to hold more government debt. So it is an issue. As a part of the Basel III regulations, we do have to anyway actively hold government debt. So there is an element from that. Obviously, that portion has now increased. We do think that the risk of holding government debt has to a large extent receded. It was heightened last year, but it is receding. We're not, like I say, if we don't have a level 5 lockdown, you will have some kind of economic recovery. Most of the bad news to a large extent have been priced into the currency. So you're not going to have that sort of volatility coming through. And we are seeing a normalization in trade. I have to tell you, from the banking side, we saw less transaction volumes during adjusted level 3 that we had in late December and January. But January is always seasonally slow going. And since that was lifted, we have seen quite a lot more activity coming through. So we're fairly confident that the economy, the wheels will turn. It won't be impressive growth. It will be moderate growth. But that will certainly help the banking industry. And from government's perspective, they're not going to be issuing more debt this year than they did last year. I think last year was really, really the big test for the system. So, it is a systemic risk, but I think it is one that is actually reducing rather than increasing. The heightened concern was last year. Let's imagine worse comes to worse, and foreigners just completely withdraw, as you mentioned, on the credit quality. What would happen then? Would banks fold? The Reserve Bank will have to step in. The Reserve Bank will have no choice but to do that, because the systemic risk to the system, the likely consequences of the banking sector coming under severe pressure, would be absolutely disastrous for South Africa. And then you are talking about a Venezuelan type scenario, an Argentinian type scenario. And the Reserve Bank will step in. I can tell you, though, that we are light years away from that. Banks are still very well capitalized. They are still sitting with healthy balance sheets. And generally speaking, the debt that they have to take on, the additional sovereign debt they had to take on, they can more than manage.
Well, it's always good to highlight those risks, and Nicky, you've got a way of always just explaining them so well. I think one of the other risks that have certainly come to the fore, well, most recently, I think, has been around the risk of inflation, whether it's global inflation and how this feeds through into South Africa. So yesterday, we obviously saw that increase in the fuel levy. We've got high electricity prices, higher commodity prices in terms of the oil price, and I think the concern there is that yes, we're most likely going to be sitting between that 3 to 6 band that the South African Reserve Bank is looking at. But these inflation concerns that we've seen from a global perspective now filtering into South Africa, should we then be concerned? And if that's the case, is an interest rate hike then on the cards for South Africa?
Well, certainly the Reserve Bank's already talking about an interest rate hike, but I tell you what, let's first deal with the global inflation story, right? So let's break this thing down. That is probably the most fascinating debate occurring at the moment, okay? And it's all based on what people believe will happen, right? It is not things that are actually happening. It is what they believe will happen. So let's bear in mind, what are these factors that will come into play that they believe will create inflationary pressure? Well, there's the argument of excessive money printing and, really ramping up the printing presses as the global economy starts to recover, and that can ultimately create a situation where you could have inflationary pressures. That's one argument. The other part of those arguing that this could be inflationary is, of course, that the focus to a large extent is now shifting away from monetary policy globally to fiscal policy. And we see that in the EU, they've come out with a recovery plan, which is a very significant slice of the Eurozone's GDP, and that will be aimed at certainly the transitioning the Eurozone economy to a green economy and all the infrastructure investment that will have to occur related to that. More importantly, Joe Biden has come with a 1.9 trillion stimulus package, which a big portion is just spending, literally checks to companies and households to carry them through this transition. But another big portion is about getting infrastructure spending going and also getting America moving towards a greener, more sustainable future. So the argument being is once all of this expenditure gets online, you're going to have shortages, you're going to have increased demand for commodities, commodity prices are going to start rising, oil prices are going to start rising, and that will create inflation. Now, firstly, in my experience of all government expenditure, even efficient governments, look at the EU, they still haven't started rolling out that spending. That was announced early last year. This is going to be the same in the United States. It's going to be slow. It would be a good thing if it happens, especially if it goes towards infrastructure spending, but it's not necessarily going to be creating inflation. I don't think there is sufficient evidence at this point to suggest that it will. Yet that is what the markets are expecting. What it will definitely do is boost commodity prices, which is good for South Africa. And it will also increase demand for commodities, which is also good for South Africa. So the inflation debate globally isn't a given. Let's just first put that out there. Then locally, yes, we are seeing higher electricity tariffs, over 15% that's been given to Eskom. That will be a source of inflation. Oil prices are moving from a very low base back to normal levels, not excessive levels, but normal levels. That's going to be a source of inflation, especially off that low base. But here's the thing. Countering that is subdued demand, very selective consumers. In other words, all retailers out there and all the companies we talk to, whether it's be a Pick Pay, whether it be a Woolworths, they know to move volume, they have to discount, all right? Because South African consumers are highly price aware because they've lived in tough times for so long. So subdued demand will to a large extent contain that. And then the rand is a lot firmer than it was. So that will largely offset a lot of the oil price pressure, a lot of the imported cost you might be taking on. So overall, inflation might be a little bit higher than the Reserve Bank's estimated, but it won't be dramatically higher. Okay, so, and will it still be within their band? Yes. Yet the Reserve Bank's already indicated, remember, they're not targeting 3 to 6%. They are targeting 4.5%. And for them to keep inflation at 4.5%, which is the midpoint of the range, it's already been made clear by them that their quarterly projection model suggests that they should hike interest rates this year, they should hike in the second quarter, and they should hike in the third quarter. Frankly, I think that would be equivalent to hiking taxes this year. You know, in the same way that it would have been absolutely ridiculous after such a tough year to push up taxes, it will be equally ridiculous, in my opinion, to move interest rates higher when inflation, at worst, is maybe going to touch 4%, which is still below the level you're targeting. All right. So I'm not convinced that's going to happen. We are expecting flat rates, but it's a risk people should be aware of. Their projection model is indicating hikes of 25 basis points each second quarter and third quarter.
Well, Nicky, we're nearing the end of our discussion now, but just before we get your closing thoughts, I thought it's probably maybe a good idea for us to highlight some of the, the positive aspects in the budget. I mean, Operation Vulindlela, for example, has been making progress. We have had, over 10 billion rand that's been allocated to the COVID vaccination drive. So there are things that are being done, and there is, positivity that, we can look to in terms of this budget. If you were a credit rating agency, and I know people are sometimes obsessed with ratings, and I happen to be one of those people, how would you rate this particular budget? And do you think that this would be enough to satisfy credit rating agencies?
I think they certainly hold. I think that's going to be their conclusion. The intent has been signaled, certainly through the expenditure estimates going forward. They are addressing the main issue that rating agencies have always raised, that your public sector wage bill is growing at an unsustainable level. That is where they're focusing their attention. So as a rating agency, I would hold. I'll keep ratings unchanged. But what I would like to see over the next 3 years, probably more than anything else, is that we start to pass the laws we said we will. In other words, go and change the legislation you claim you will do very soon regarding embedded energy. Get on with the bid window 5 for renewable energy. Release spectrum. Get that over and done with. Make progress with these low-hanging fruit. Then I think certainly rating agencies will be happy with where we're going. If we can add to that public sector wage bill constraint, then I think that we're safe for now. And we might even see towards the end of this 3 years, if we can achieve this, that they might start to upgrade our ratings outlook. But it's critical that those are the things we need to address. We need to start implementing.
Yeah. Nicky, thank you so much for your time. Maybe before we go, just to wrap up some of those key points from your presentation today, I think from what we could have taken away is firstly that, yes, the economic outlook is uncertain, but there certainly is scope for us to, to reach those revenue targets. And I think the COVID-19 vaccine drive will certainly be a key determinant of that. And yes, there are risks to, to the fiscal framework, the public sector wage bill, the state-owned companies. But I think what was also quite comforting hearing from the minister yesterday in a media briefing, he said, he used to actually be involved very heavily in negotiations when when that was one of his portfolios. So he's leaning on that and hoping that the outcome that we had in December will then be repeated. And maybe on a final note, in that yes, implementation risk is high, but like we said, we have seen some positive developments that have come through. Nicky, thank you so much for always highlighting those points for us and just giving us a sense of what this budget really means for us and things to take into account. That was Nicky Weimar. She's the Group Chief Economist at Nedbank. Thank you so much for staying with us. Of course, we always do welcome your feedback, which is what we're going to be asking for you right now. On your screen will be a QR code. So how it works is that you just pull out your phone, you go into your camera and you scan the code, and then we'll be able to get that feedback. So we do like to hear from you, and of course us here at Nedgroup Investments will continue to engage with you and have these regular webinars. Next week you can look forward to a balanced perspective, and on the 25th of March, Nedgroup Investments Multi-Management will be bringing you their investment insights. That is it from us today, from me and the production team. Thank you so much for joining us, and take care and stay safe.